Thank you all for joining our webinar today on interval and tender offer funds. Asset managers and distributors have been exploring these funds as retail investors look to participate in alternative investments. Today, we are delighted to host an expert panel to discuss a comparison of these funds with traditional closed-end funds, mutual funds, ETFs, and private funds. The panel will cover regulatory and other considerations, including portfolio liquidity requirements, restrictions on leverage, affiliated transactions, investments in other funds, and marketing associated with these funds. With that overview, I'd like to introduce our excellent speakers from Wilkie, Farr, and Gallagher. Justin Browder is a partner in Wilkie's Asset Management Group based out of the Washington, D.C. office. He concentrates his practice on counseling advisors, funds, and broker-dealers on all aspects of federal securities laws. Elliot Gluck is a partner in Wilkie's Asset Management Group based in New York. His practice focuses on representing mutual funds, closed-end funds, ETFs, private funds, and their investment advisors. And Benjamin Haskin is a partner in the Asset Management Group based in Washington and Chicago. He advises mutual funds, ETFs, private and offshore funds, advisors, and broker-dealers on investment management issues, including compliance, corporate governance, enforcement, and regulatory matters. So please feel free to send in questions, and the speakers will do their best to address them at the end of the presentation. Now I will turn it over to our panel. Ben, over to you.
Thanks, Monique, and thanks for the introduction. And just as a prefatory matter, we'd like to thank the IAA for organizing this event. We really have been looking forward to it, and we're happy to talk about the subject matter. We're going to talk, as Monique noted, about interval funds and tender offer funds today. And we're going to do some comparisons with some traditional products so that people can understand the differences. Many managers we know have been looking at these products or have initiated investment in developing the infrastructure for these products in recent years and have entered the market because of the need or the desire to offer alternative asset classes to retail investors. Some of the asset classes that these funds tend to be well suited for include some sorts of private equity investments, investments in hedge fund-like assets, and also some private real estate investments. But these are registered funds, and they offer the opportunity to effectively offer some alternative asset classes to more retail type investors. And that's going to be, an important theme that we will discuss throughout this presentation. These funds are a form of closed-end fund, but they have some attributes that make them more hybrid, that are more similar in some ways to mutual funds and ETFs. And like a closed-end fund, they can hold less liquid holdings than mutual funds or ETFs. As we go on, Elliot's going to discuss some of the key regulatory considerations related to interval and tender offer funds. And Justin will then discuss distribution and marketing considerations, as well as some other 1940 Act considerations. If you could turn to the next slide, please. So as we go through this, you'll see some of the key features that we'll discuss is the limited need for liquidity, unlike some other products, the ability to engage in a continuous offering, and the lack of need for cutting a net asset value or NAV daily or making daily redemptions. So, and one other sort of prefatory note, we will not be discussing business development companies today, which is another type of alternative product that has some of the same attributes, but we will be focusing solely on the interval funds and tender offer funds. So let's start with the basics. What's an interval fund and what is a tender option fund? Why don't we go to the next slide? So as we noted, they're similar to other types of closed-end funds, and they're often viewed as hybrids of open-end mutual funds and traditional closed-end funds. An interval fund is basically defined by rule under the 40 Act as a fund that opts in to Rule 23C3, and it makes repurchase offers of between 5 and 25% of the fund's outstanding shares at intervals of 3 or 6 or 12 months. In contrast, a tender offer fund essentially has more flexibility on when it's going to make tender offers, which are made on a discretionary basis. But both funds are similar, both types of funds are similar in that they permit the funds to essentially have limited offers to repurchase shares, which gives investors some liquidity, but the majority of shares will be held for the longer term, and therefore the funds can invest in less liquid offerings. We can turn to the next slide, please. Because of the lack of a need for daily liquidity, interval and tender offer funds are not subject to the SEC's liquidity risk management rule and the related requirements. That rule limits a mutual fund or an ETF's investments in illiquid assets to 15% of its net assets. And illiquid assets are defined for that purpose as assets that can be sold at approximately their current price within 7 days. And as Elliot will discuss in more detail as we get deeper into the presentation, not only is it not subject to the liquidity rule, but the way that liquidity is assessed for these funds is a little different than it is for mutual funds or ETFs. As we've discussed, they are subject to regularly scheduled repurchase offers, or they may make discretionary repurchase offers. And because they're subject to a cap of amount, essentially most assets that are held by the fund can be less liquid. And they can also pursue more concentrated strategies and invest in non-traditional assets, as we've discussed previously, various kinds of alternative assets without being subject to volatile cash flows. And of course, as we know, many distributors of fund assets have been looking for ways to distribute alternative classes of assets to more retail investors because they may be non-correlated or less correlated with the general markets. And there is a belief, at least among some who do asset allocation, that a limited allocation to alternative assets may be a good enhancement for an individual's portfolio. Turning to the next slide. So you can turn to the slide after that. So these funds, engage in continuous offerings. They essentially are able to sell. Sometimes they're registered under the 33 Act and may open to new investors as needed, but they can replenish the cash. And because they can engage in continuous offerings, unlike other products, they essentially, like other closed-end funds in particular, they can continue to gather money, and this makes them both less subject to the volatility of cash, but also allows them to grow over time. And therefore, for managers, this can be a slow and steady way of growing assets that are less likely to move quickly. And it alleviates the need to sell existing portfolio holdings to generate cash for new investments. Next slide, please. As we noted, their public offerings may be made here, or they can be offered to accredited investors and qualified purchasers. And we'll talk a little bit about some of the reasons that they may be limited to qualified purchasers in a few minutes. So there's a choice to be made here, and there are various reasons to make the choice as to whether to offer to under the 1933 Act and therefore register the funds under the 33 Act, or pursue an exempt offering primarily to accredited investors pursuant to Reg D, somewhat similar to some kinds of hedge funds, but in a more retail sense than the qualified purchasers that you're subject to for many hedge funds. But generally, the point of these structures is to be able to have continuous offerings without a public offering or exchange listing. As Elliot will discuss a little bit later, there are some individual funds or some reasons why sometimes some of these funds do pursue exchange listings, but it's not the dominant case so far. And as we'll discuss in more depth a little bit later, the SEC has taken a position that limits certain types of investments, particularly investments in private funds by interval and tender offer funds, unless they limit their offerings to accredited investors. And the reason that they do that is the SEC is concerned that these funds might be a way of indirectly offering a truly private fund to a public audience, that's sort of doing indirectly what you can't do directly, and therefore has posed some limitations on the ability to invest in private funds. And we'll discuss that in more depth later on. Next slide, please. Performance fees are often a concern for managers, and there is some ability to use performance fees. If you limit the offering to qualified clients, you can charge a traditional performance fee. However, that may be too limiting as to the retail investors that you seek to offer the fund to. So then there's more limited types of performance fees that might otherwise be charged. Performance fees that only are based on sharing a portion of the income and not the capital gains is one option. And then under the 40 Act and the Investment Advisors Act, there is a limited form of performance fee called a fulcrum fee, which basically adjusts the advisor's compensation relative to a benchmark index. So if you use the S&P 500 as an example, as a benchmark index, you could get an extra effectively portion of the fee if you beat the index over the reference period. But we haven't seen a whole lot of fulcrum fees used for these funds. Next slide, please. It's worth noting that there are a number of 1940 Act requirements that apply. A good deal of the 1940 Act, of course, applies to these funds because they are registered under the 1940 Act. And unlike private funds in particular, the 1940 Act is fairly intrusive and covers a wide variety of areas. We have some of the key areas on the slide here, including having an independent board that has a number of duties and responsibilities, which Justin will discuss later. There are valuation and liquidity monitoring aspects, and in particular, there's a valuation rule that applies. There are leverage limitations. Being closed-end funds, these are less restrictive than open-end funds or ETFs, but there are statutory leverage limitations. There are extensive reporting and disclosure obligations. There are limits on affiliated transactions, which we'll discuss later. There are certain requirements for certain kinds of service providers, particularly fund custodians, but some others. And there are some rules governing investments in other funds. So next slide, please. So to recap a little bit here on a few items, we'd like to focus again, the importance of these funds is that they can engage in continuous offerings, but they only partially have to have a liquid portfolio, unlike open-end funds and ETFs. Unlike open-end funds and ETFs, they don't have to offer daily redemptions. They don't have to calculate their NAV daily. And they make periodic redemptions rather than daily redemptions. And as we discussed, there's some possible use of performance fees, and under limited circumstances, there may be some managers who may want to consider exchange listing. So with that, turning to the next section, which is regulatory considerations, I'm going to turn this over to Elliot to drill deeper into some of the issues we just discussed.
Great, thanks, Ben. So as Ben mentioned, there are a lot of regulations that apply to interval funds and tender offer funds. They are 40 Act registered funds, and a lot of restrictions and regulation. Today, I'm going to focus on some unique aspects of that regulation as they apply to interval funds and tender offer funds relative to other registered funds. And then we'll talk about some other just general 40 Act regulatory considerations. And Justin's going to continue to talk about some other 40 Act considerations as well, in addition to certain other matters. But if we flip to the next slide, what makes an interval fund an interval fund? relative to another closed-end fund. So an interval fund is a registered closed-end fund, but it, as Ben mentioned, it makes repurchases of its shares pursuant to Rule 23C3 under the 40 Act. And that requires it to adopt a fundamental policy, which is a policy that is hardwired into the fund, one that cannot be changed without approval of a majority of shareholders. And that fundamental policy requires it to make repurchase offers on an interval basis, right? So every 3, 6, or 12 months. So it's going to dictate in its fundamental policy whether it's a quarterly repurchase offer fund, a semi-annual repurchase offer fund, or an annual repurchase offer fund. And each repurchase offer has to be between 5 and 25% of its outstanding shares at the time. The repurchase offer amount is not something that is hardwired into the policy, and rather is something that is approved by the fund's board before each repurchase offer. So that provides the fund with a little bit of flexibility. But the periodic interval is hardwired in and has to be done every period other than in one instance, and that is the interval fund gets a pass if it wants to take it for its initial period. So for the initial period after the effective date of an interval fund's registration statement, it can skip its first repurchase offer that would be required by the period. So for example, if a fund adopts a fundamental policy to engage in quarterly repurchase offers, ordinarily the first repurchase offer should have to occur within 3 months after the effective date of the fund's registration statement. But the fund can, if it chooses to, skip that first repurchase offer and do its first one at 6 months after effectiveness. And the reason for that is to give the fund the ability to ramp up its investment strategy without any concern for near-term outflows. One item of note, Rule 23C3 also allows for, in addition to periodic repurchase offers, allows for an additional liquidity event of one discretionary repurchase offer once every 2 years. And that provision actually can be relied upon by a fund that doesn't operate as an interval fund. So even a closed-end fund that hasn't adopted a fundamental policy to make periodic repurchase offers, it can choose to rely on Rule 23C3 to make a discretionary repurchase offer once every 2 years as an alternative to perhaps conducting a tender offer, which would be another way to offer liquidity to shareholders. And we'll talk about that in a second. So for the repurchase offer amount, the fund will set the repurchase offer amount between 5 and 25%. If the fund receives repurchase requests in excess of the repurchase offer amount, well, it can choose to increase the repurchase offer amount by up to an additional 2% in its discretion. It can choose not to. But whether or not it chooses to opt into that additional 2%, if there are still oversubscriptions, the fund has to make repurchase offers on a pro rata basis, subject to certain potential very limited exceptions. If we move on to the next slide, and we talk about tender offer funds and how they conduct their repurchase offers. So they conduct their repurchase offers not pursuant to Rule 23C3, but rather pursuant to Rule 13E4 under the Exchange Act. And unlike an interval fund, a tender offer fund is not required to conduct tender offers on any fixed periodic basis or for any specific amount of outstanding shares. Rather, the fund's board has the flexibility to determine if and when the fund will conduct tender offers and the amount of any tender offer. But despite the flexibility offered to tender offer funds, in order to give investors some idea of the liquidity to be offered or anticipated to be offered by the tender offer funds usually adopt policies to conduct some sort of regular tender offers of certain minimum amounts that they disclose to shareholders. And they're not bound by that. And usually the disclosure will indicate that a tender offer is not guaranteed, but that is something that is usually set out in a tender offer fund's registration statement, so that shareholders can know to differentiate this fund from another closed-end fund that has not sort of committed itself to make any tender offers. Like interval funds, if there's an oversubscription, so if tender shareholders oversubscribe and there are more shares tendered than the fund is willing to repurchase, then the tender offer fund will make the repurchases on a pro rata basis, subject again to certain potential exceptions. If we move to the next slide and we talk about the timing of repurchase offers. So for interval funds, again, they're governed by Rule 23C3, and that sets out strict parameters for the timing of the periodic repurchase offers, which has to be, again, set out in the fundamental policy. And so the way it works is the board will approve a repurchase offer amount in advance of the periodic repurchase offer. So let's say it's on a quarterly basis. Each quarter, the board will approve a repurchase offer amount. And then the fund will send a notice to shareholders, which will inform shareholders of a number of things. One, shareholders will be informed of the repurchase offer amount. Is it 5%? Is it 15%, 25%, whatever it may be, whatever the board approved. They'll also be informed of the repurchase request deadline, which is the date on which they need to submit their request for repurchase and the amount of shares that they would like the fund to repurchase. And that deadline has to be under Rule 23C3. That deadline has to be between 21 and 42 days from the date of the notice. In addition, the notice is going to set out the repurchase pricing date, which is generally under the rule, generally within 14 days of the repurchase request deadline, although it could be advanced to an earlier date. That's the date at which, that's the price that the fund will pay for the shares tendered for repurchase. And lastly, it'll set out the repurchase payment deadline, which is the date that shareholders are going to get paid for their shares. And that has to be within 7 days of the repurchase pricing date. And this notice of repurchase offer is something that has to be filed with the SEC. It is a public document. It's filed with the SEC within 3 days of sending it to shareholders. As I mentioned earlier, these periodic repurchase offers are hardwired in, and an interval fund cannot suspend or postpone a repurchase offer except under very limited circumstances, including, for example, if it would cause the fund to lose its status as a regulated investment company under the Internal Revenue Code, or if the fund happens to be listed on an exchange, if conducting the repurchase offer would result in its delisting of shares. And any suspension or postponement, if it meets the limited circumstances under which it's permissible, would have to be approved by the board, including a majority of the board's independent directors. If we move to the next slide and we talk about the timing of repurchase offers for tender offer funds, well, there's a lot more flexibility for a tender offer fund. So the board, like an interval fund, the board of the tender offer fund will approve a tender offer. And after that approval, the fund will send shareholders information regarding the tender offer. That information is dictated by Schedule TO and has to be filed with the SEC. But the timing is such that the tender offer has to be kept open for at least 20 business days from the date of the offer's commencement, after which the repurchase price is determined. And just a note, while the tender offer is open, there are certain disclosure obligations under Rule 13E4, and so funds need to be careful about any public statements that they're putting out. Also may need to be filed under Schedule TO because they may be deemed to relate to the tender offer. So that's something to keep in mind. But a tender offer fund has to make redemption proceeds only promptly. There's no mandated requirement like for interval funds to make a payment of redemption proceeds within 7 days after the repurchase pricing date. And that flexibility I'll talk about in a couple minutes as to why it may dictate, whether or not you choose to structure a fund as an interval fund versus a tender offer fund. So if we move to the next slide and we talk about liquidity requirements, closed-end funds generally under the 40 Act don't have any liquidity requirements. Open-end funds, on the other hand, do have liquidity requirements and cannot invest more than 15% of their assets in illiquid investments. Interval funds is sort of a hybrid closed-end fund. So they're a closed-end fund. They don't generally have liquidity requirements, but while they are conducting a repurchase offer, more specifically, from the time that they send a repurchase notice until the repurchase pricing date, interval funds are required to hold liquid assets equal to 100% of the repurchase offer amount. And so that time period under the rules can be anywhere from 21 days to 56 days. And if the fund does not meet that requirement, the board has to cause the fund to take such action as it deems appropriate to assure compliance with this requirement. So what does liquid mean? Liquid for this purpose means assets that can be sold or disposed of in the ordinary course of business at approximately the price at which the company has valued the investment between the repurchase request deadline and the repurchase payment deadline, or assets that mature by the next repurchase payment deadline. The rule also requires the boards of interval funds to adopt written procedures to ensure that assets are sufficiently liquid so that the fund can conduct its repurchases, and also to ensure that the fund has liquid assets equal to 100% of the repurchase amount during the required period. For tender offer funds, if we move to the next slide, actually, for tender offer funds, there's a lot more flexibility as to liquidity. There are actually no restrictions on liquidity during the tender offer period or at all for tender offer funds. Again, tender offer funds have a requirement to pay for tendered shares promptly rather than within a mandated 7-day period. And so, that would be the reason as to why they don't have a liquidity requirement. There's a lot more flexibility and cushion to make payment for the tendered shares. And given that flexibility, a tender offer fund can, for example, delay payment of proceeds to match the liquidity timeline of its underlying investments. For example, you may have a tender offer fund that invests a registered fund of hedge funds, that its underlying hedge fund investments themselves have limited liquidity. And so tender offer fund may want to delay the payment of proceeds until it can receive proceeds from its underlying investment, and it can match that liquidity timeline. A tender offer fund also may decide to pay partial proceeds. So for example, it may say pay in sort of short order 95% of the redemption proceeds, but hold back 5% to allow it to conduct an audit and pay that additional 5% or the adjusted amount 30 to 60 days later after the tender offer fund is able to conduct an annual audit. So as a result, tender offer funds can invest in a broader range of asset categories than interval funds, and time the payment of the repurchase proceeds with the liquidity of their underlying investments. And so that's going to, depending on the type of fund or the strategy and the underlying investments, that's going to dictate whether a fund that is choosing to be a limited liquidity fund, whether it chooses to operate as an interval fund versus a tender offer fund. If we can move actually to the next slide and just talk about more.
Elliot? I'm sorry to interrupt. Could I just ask you a quick question?
Sure.
Do you find that particular asset classes are more appropriate for interval fund or tender offer fund? Does the type of strategy impact the type of fund that you would select?
I think it's, yes. I mean, it's more the nature of the underlying investment. So we've seen a lot of funds let's say registered funds, a hedge fund, as I mentioned, or registered funds of private equity funds where there is some limited liquidity in the underlying investments, or even if it's not underlying funds, but underlying private investments where there may be limited liquidity, you may um, opt to structure it as a tender offer fund. An interval fund is a closed-end fund and doesn't generally have liquidity requirements for most of the year, but is going to have to make repurchase offers. And so, it also depends on the interval, right? So an interval fund that does annual repurchase offers is only going to have to concern itself with liquidity once a year versus a quarterly repurchase offer fund. Every single quarter, it's going to need to have a certain amount of liquidity. And so it absolutely does depend on the nature of the underlying investments. And that's going to help dictate the structure. Again, whether you're a tender fund versus an interval fund, and also if you are an interval fund, how often you are going to conduct quarterly repurchases. So for now, if we on slide 21, just switching to some general 40 Act requirements here, and Justin's going to talk about some others, but 40 Act funds, in this case, closed-end funds, interval funds and tender offer funds, are subject to certain leverage requirements. And those leverage requirements are dictated by Section 18 under the 40 Act. And they're usually, they are defined in terms of the issuance of senior securities, right? A 40 Act fund cannot issue senior securities representing indebtedness or representing stock. More specifically, interval funds and tender offer funds can issue senior securities representing indebtedness, meaning they can, for example, borrow from banks and non-banks or issue notes, provided that the fund has asset coverage with respect to any borrowing of at least 300%. What that basically means is that the fund, after its borrowings, cannot exceed its assets more than 3-to-1. So, for example, if a fund has $100 in net assets, it can borrow $50 because after the borrowing, the fund will have $150 in assets, $50 in borrowings, and that would equate to 300% asset coverage. And the ability for closed-end funds to borrow is more expansive than open-end funds, and that open-end funds can only borrow from banks, whereas closed-end funds can borrow from non-banks as well. They can issue notes. And so there's a little more ability for closed-end funds. Closed-end funds, including interval funds and tender offer funds, can also, unlike an open-end fund, issue preferred stock. And in preferred stock, the asset coverage requirement is 200%. Interval funds are also subject to an additional restriction under Rule 23C3, that any senior security issued or other indebtedness has to mature by the fund's next repurchase pricing date or be redeemable, callable, or repayable without penalty or premium by the fund's next repurchase pricing date so that the fund can meet its repurchase obligations. And then lastly, I'll just note in terms of leverage, there is an ability to leverage through derivatives as well. The regulatory regime for that is changing. Right now, there's an asset coverage requirement under SEC and SEC staff positions where a fund has to segregate liquid assets equal to its obligations under derivative contracts. But the SEC recently adopted a new rule, Rule 18F4, which tests for which allows a fund to engage in derivative transactions subject to a value at risk test, which is something we don't have time to discuss today, but it's a new method of limiting the fund's ability to engage in derivative transactions, but at the same time allowing for it as well. And if we move to the next slide, I'll just to talk about NAV. An interval fund is required to calculate its NAV at least once weekly and on each day that the fund offers its shares for sale. And when it's doing repurchase offers, it's required to calculate its NAV on the repurchase pricing date and on each of the 5 business days prior to the repurchase request deadline. For tender offer funds, they are not required to calculate NAV at least once weekly. Instead, like private funds, they typically tender offer funds typically calculate NAV on days that investors are allowed to purchase or sell fund shares as determined by the fund. And so both tender offer funds and interval funds, this ability to calculate NAV less frequently really does work for them given the less liquid strategies, and provides them with more flexibility than they have in a relative, let's say, to a mutual fund or an ETF, which has to calculate NAV on a daily basis. So with that, I will turn it over to Justin, who's going to talk about some other considerations relating to these funds.
Okay, great. Thank you, Elliot. I'm going to talk a little bit about distribution and marketing. So interval and tender offer funds can be marketed to retail investors through traditional channels that are open to open-end mutual funds. And these include mutual fund supermarkets that are often utilized by independent RIAs, as well as other brokerage platforms that are accessible to investors on a self-directed basis. And for most funds, what this means is that there's no requirement to pre-qualify investors based on a qualified purchaser standard or an accredited investor standard. And there's one caveat, and I'll mention that in a few minutes. But these funds can compete with open-end funds in the market for retail investors. As with other funds that are sold by broker-dealers, however, recommendations to invest in interval funds and tender offer funds are subject to Reg BI, which imposes a fairly comprehensive new compliance framework on broker-dealers to ensure that recommendations are made with investors' best interests in mind. So Reg BI imposes several component obligations, but what's most relevant to fund sponsors who are new to the space is the care obligation. And that requires brokers and registered reps making recommendations to consider the risks, rewards, and costs of a recommendation in light of a customer's risk tolerance and other financial circumstances. But also, and this is kind of the most important piece, but also they have to use a comparative analysis that considers the other investment products that are reasonably available on the broker's platform. So it becomes particularly important for new sponsors who are entering this space to make sure that the terms of their fund offering are in step with the rest of the market, the funds that broker-dealer reps are going to have to compare against. Great. Can we move to slide 24, please? Historically, closed-end funds were subject to a number of restrictions on offering materials that apply to open-end funds. And these restrictions relate to so-called gun jumping. And what gun jumping is it's the making of an offer of securities before a registration statement has been declared effective with respect to those securities. And because the term offer under the 33 Act is construed so broadly, it's fairly easy for issuers to run afoul of the gun jumping restrictions unless an exemption applies. So last year, fortunately, the SEC adopted a series of rule amendments that permit closed-end funds to rely on some of the same exemptions that are available to operating companies to make public statements in connection with an offering. So the upshot is that in addition to Rule 482, which is kind of the core advertising rule under the 40 Act that applies to all registered investment companies, tender offer funds and interval funds can rely on other more flexible rules that permit them to compete more broadly with different types of investments that are available. So among other things, closed-end funds can now publish factual information like tombstone ads. They can make certain factual statements about the fund before a registration statement is filed, as long as the statement doesn't reference a particular securities offering. They can make use of free writing prospectuses in certain circumstances after a registration statement has been filed. And free writing prospectuses can be used more broadly in a wider variety of scenarios than traditional investment company advertisements that are filed under Rule 482. So closed-end funds can utilize offering rules that are just not available to traditional open-end funds, which makes them that much more compelling when selecting a registered fund product. Let's go to slide 25, please. Unlike open-end funds, interval funds and tender offer funds have to obtain exemptive relief to offer different share classes and to enter into arrangements to permit the fund to impose asset-based distribution fees, which are permitted for open-end funds under Rule 12b-1. And although it adds to some of the administrative hurdles in launching an interval fund or tender offer fund, obtaining multi-class and distribution fee relief has become somewhat standardized, and the relief can substantially help the fund access sales channels that might not otherwise be available. I think there was a question from the audience which we can address later, but this is how you can structure an interval fund to offer multiple share classes within the same fund structure. You have to obtain exemptive relief. The multi-class exemptive orders that are typically granted to interval and tender offer funds require them to comply with a number of conditions, including certain 1940 Act rules that apply only to open-end funds, and they have to comply with those rules as if the funds were subject to them directly. There's one point to note here, and that is around disclosure with respect to sales loads that are assessed by individual selling agents or individual broker-dealers in the sales network. And there's a debate among practitioners about whether under the standard multi-class relief, a fund has to disclose in its prospectus the different types of sales loads that are charged by brokers. In our view, that's not a requirement. And so brokers can assess sales loads that vary by firm without the need for funds to schedule them out, which again provides for more flexibility to fund sponsors than is the case in the open-end fund context. Okay, slide 26. Okay, the restrictions under Section 17 of the 40 Act, which apply to all interval and tender offer funds, are some of the most fundamental limitations under the statute. And essentially what they do is prohibit funds from engaging in principal and joint transactions with both first tier and second tier affiliated persons. So that's affiliates of the fund as well as affiliates of such affiliates. Section 17 is far more restrictive and broader and distinguishable from Section 2063 under the Advisors Act, which permits principal transactions with notice and consent from clients, and also permits joint transactions subject to an advisor's overarching duty to make sure that allocations are fair and equitable. So it's a little bit of, it takes some getting used to work under the Section 17 restrictions for advisors that are used to managing unregistered products. And the Section 17 in truth can pose a fair degree of challenges for sponsors that are looking to manage interval funds or tender offer funds alongside private funds that pursue similar strategies. And that's because in order to pursue a co-investment strategy, there's no notice and consent provisions like there are under 2063. You actually have to seek and obtain exemptive relief from the provisions of Section 17. And like multi-class relief, which I talked about a second ago, the process of obtaining co-investment relief has become somewhat standardized, but it similarly adds to the administrative hurdles that need to be considered in order to launch a fund. And there are a number of conditions that are required under the terms of those exemptive orders. So for fund sponsors that are managing private funds that are making a first entrance into the registered fund space, if co-investment is going to be important so that you can operate and manage a private fund alongside a registered closed-end fund, it's critical to understand the terms and conditions of the typical co-investment relief earlier rather than later, so you can understand kind of what other considerations that need to be taken into account as you start to go to market. So let's go to slide 28. Okay, a note about board governance. In contrast to private funds, which are generally managed by investment advisors and their affiliates, like their general partners, the 40 Act places a significant amount of governance responsibilities on an independent board of directors. And the board is charged with approving the advisory contracts, for example, both on an initial and an ongoing basis. They have to consider a significant amount of data in approving those contracts on an ongoing basis to avoid civil liability under the 40 Act. They also are in charge of approving compliance matters. That is the board. The board is in charge of annually reviewing written policies and procedures that are designed to prevent violations of federal securities laws, and that's under Rule 38A1 under the 40 Act, and the analog here for folks who are more accustomed to the Advisors Act is Rule 20647. The board's also in charge of valuing fund investments, which can be a really critical responsibility in the case of interval funds, which are required to maintain liquid investments sufficient to satisfy redemptions, as Elliot mentioned. In addition, for interval funds, boards are in charge of approving the fundamental policy governing periodic repurchase offers, and they have to approve procedures to maintain liquid assets to satisfy repurchase requests. The board is predictably subject to a fairly comprehensive set of fiduciary duties, and they're subject to regulatory liability for fiduciary failures. And then one thing I note about the composition of the board, so under Section 16 of the statute, 40% of the members of a fund board must be independent of the fund, its advisor, and its principal underwriter. However, to take advantage of certain exemptive rules under the 40 Act, the board actually has to consist of at least 50% independent board members. And in practice, most boards have a supermajority of directors to consider circumstances, for example, where you have a director who resigns, so you ensure that you are above that 50% threshold on a go-forward basis. And the independent directors retain their own independent counsel who acts as an additional safeguard to protect the interests of shareholders. And there's just an additional layer of considerations when working with an independent board under the 40 Act regime. Okay, slide 29, please. So the statute also incorporates a fairly comprehensive set of requirements that govern a fund's relationship with its service providers. So that includes transfer agents, underwriters, custodians, and accountants. And because an interval or tender offer fund has features of both open-end and closed-end funds, the processing of redemption and share purchases can pose fairly significant administrative challenges, and it becomes that much more important for fund sponsors to think carefully about service providers who are set up to process redemptions in line with Rule 23C3 and the tender offer structure under the 40 Act. It is actually a fairly manual process that requires careful implementation, although there have been a number of service providers who have developed automated processes over the last few years in response to market demand. Broker dealers who sell closed-end fund shares like tender offer funds and interval fund shares also have to comply with Rule 2341 under the FINRA rules. And FINRA Rule 2341 imposes a significant amount of rules and requirements related to the sale of investment company shares. And all broker-dealers who play in this market are intimately familiar with 2341. But 2341 is an important rule set for fund sponsors who might be new entrants to the space to review and consider before they dive headfirst. Let's go to slide 30. Okay. Interval fund and tender offer funds also have to register their shares under the 33 Act by filing and the 40 Act by filing Form N2. N2 requires comprehensive information about the fund's investment objectives, fees, risk management personnel, portfolio management personnel, so portfolio managers and board members, conflicts of interest, tax structure, distribution arrangements, if applicable, and service providers. The disclosure requirements that apply under N2 are similar, but in some cases more comprehensive than the disclosures that you typically see in a private placement memorandum that's put out by private fund sponsors. Registration statements are subject to SEC review and comment by the Division of Investment Management. In the period of time between the initial filing and the SEC declaring a registration statement effective, typically takes between 90 and 100 days, 120 days, excuse me. But for funds with unique strategies, that timeline can be extended. Prior to effectiveness, a closed-end fund has to be seeded with $100,000 in seed capital. And then funds that wish to engage in a continuous offering have to file annual updates to their registration statements. But those typically can go effective without SEC review and approval, except in certain special circumstances. Of course, fund advertising also has to be consistent with the prospectus disclosures that are made, and that's something to keep in mind as you engage marketing staff to think about going to market with one of these products. So let's go to slide 31. A quick note about fund-of-funds arrangements. So in general, the 40 Act limits the ability of registered investment companies to invest in other registered investment companies. Section 12D1A of the Act prevents a fund from acquiring more than 3% of the voting securities of another fund. And then Section 12D1C, for example, prohibits a fund from acquiring more than 10% of the voting securities of a closed-end fund. So if you have an interval fund or a tender offer fund that invests in closed-end funds, they're subject to the 10% cap as well. Helpfully, last year, the SEC adopted a rule that provides an exemption from these limits, subject to compliance with certain conditions. For example, a fund that invests in other funds is prohibited from controlling the acquired fund. A fund that invests in other funds and holds a certain percentage, above a certain percentage of the underlying fund's voting securities, has to mirror vote those securities. And the investment advisor to the acquiring fund has to make certain evaluations and findings before making an investment in an underlying fund. And then unaffiliated funds that enter into fund-of-funds arrangements have to enter into a written understanding memorializing the terms of the arrangement. And then there's a prohibition on 3-tier fund-of-fund structures, except in certain circumstances. 3 tiers being a fund that invests in a fund, which in turn invests in another fund. And I just want to come back to one final point, which is that the SEC staff has informally taken a position that a closed-end fund that invests more than 15% of its assets in private funds, so those are funds structured to rely on 3C1 or 3C7 under the 40 Act, has to limit the sales of its securities to accredited investors. So that is another important consideration for sponsors that are thinking about structuring an interval fund or a tender offer fund that, as part of its investment strategy, plans to invest a significant amount of assets in underlying private funds. So with that, I will turn it back to Monique.
Great, thank you. So we have one question from the audience that we wanted to ask, and then a couple others if we have time. The question relates to the fulcrum fee and how are fund managers to pick their benchmark. And then the second part of that is, can you charge 2 different performance fees depending on which class an investor invests in?
My recollection of the fulcrum fee rule is that it requires a broad-based benchmark, so a commonly used benchmark. I think you would try to tie it to the asset class that you're investing in some way. Otherwise, it's kind of anomalous to have a fixed income benchmark for an equity strategy. But it's typically going to be a broad-based, commonly used benchmark. As to the different fulcrum fees for different classes, that's basically not permissible for two reasons. One, the way fees are charged the way the fees are charged under the tax rules, they're charged at the portfolio level rather than at the individual class level. There are obviously some distribution fees that may be different, like 12B1 fees, but the advisory fee is charged at the fund level under the Internal Revenue Code, and it's very hard to have different advisory fees for different classes. In addition, as was discussed previously, you need a multi-class order for these types of funds to be able to have multiple classes, and those are fairly restrictive on what the classes can be charged in terms of differences among the different classes.
Great, thank you. We have another question about sort of market update. How many interval and tender offer funds are there? And has there been growth in the last few years in these funds?
I think, and I'm going to open this up to maybe all the panelists because we've seen different things. There's definitely been growth. We've definitely, I don't know if we have a clear number on these. I don't think the data has been necessarily captured. There's no interval fund association that's capturing the data in the way that it may be for other types of funds. But nevertheless, we've both seen some big registrants offer funds in the last couple of years. So, some big fund complexes that previously weren't in. We've seen some large fund complexes effectively purchase the interval fund or tender offer fund operations of some smaller shops to integrate them in. And of course the bigger shops have bigger distribution, so they immediately tend to be able to gather more assets. And the reason the bigger shops are jumping in is because they are gathering assets. There has been, you see I wouldn't say it's a flood, but there's a steady stream of new entrants here, either from traditional asset managers or in some of the registered variety. Or some asset managers who may have been more in the private equity or private real estate space as examples and want to diversify their offerings. I don't know, I'd like Elliot or Justin if they have anything additional that they'd like to add on that point.
Yeah, I mean, from my perspective, I've had the same experience as you, Ben. I don't know the numbers, but there definitely has been a trend towards interest in these types of funds, which is consistent with the trend to try to offer more private equity type strategies to retail investors. And, this may be the right type of vehicle for it. So I think we've continued to see that. And I think managers have taken advantage of this sort of hybrid approach.
Great, thank you. We have another question that's come in. What happens if a fund cannot keep up with their repurchase offers on a fixed periodic basis?
So that's a good question. The answer to that is it's a problem. That's the reason why Rule 23C3 has all of these rigid requirements regarding liquidity requirements. And, again, there's board procedures that are required to be adopted. So everything is set up such that that should not happen. But if a fund is experiencing challenges in keeping up with its repurchase offers, its only option, well, it's got two options. One, it could just terminate, seek to liquidate the fund, which may or may not require shareholder approval depending on the fund's governing documents. Or alternatively, it could seek to have shareholders eliminate the fundamental policy requiring periodic repurchase offers, or perhaps amend that fundamental policy to only require repurchase offers. Let's say if it's a quarterly repurchase offer fund, to move to an annual basis. But that would be its that would be its options if in that situation.
Great, thank you. Well, we've reached the end of our presentation. If we haven't responded to your question, we will do our best to get back to you after the webinar. Thank you, Justin Browder, Elliot Gluck, and Ben Haskin for an excellent discussion. We appreciate you sharing your expertise today with our members and associate members. If you have any questions, feel free to reach out to the panelists after the webinar. Thank you for joining us and have a wonderful day.